The Dow just had its worst day since April. The Fed's most hawkish split in a decade landed on the same afternoon as Microsoft and Meta's earnings, and overnight, the US actually struck back at Iran. Good morning. It's Thursday, July 30th. I'm Nick Vertucci with Eleanor Whitfield and Marcus Brooks. Grab the coffee because there's a lot to get through. Fed day turned violent, big tech split down the middle on AI spending, and there's a fresh Middle East escalation to open the morning with. We'll get to all of it, plus what's actually on deck today, which is not nothing either.
Morning, Nick.
Morning. Fair warning, I've got opinions today.
You always do. Before we get into any of that, let's clear the board. You both left checkable calls on yesterday's show, and both of them already resolved.
Mine did. I said if Meta sold off more than 5% this morning on the capex number, that's the market extending Alphabet's verdict to a second hyperscaler. It fell 4% on the initial print, then kept sliding to roughly 10 as the guidance call played out. That's not a coin flip outcome. That's a clean hit.
Marcus, yours was the mirror image.
It was, and it also came in clean. I said if Azure held in the high 30s% and the stock closed flat or higher despite a big capex number, that proves cash-generative hyperscalers get treated differently than Alphabet was. Azure did 43% constant currency, way past even my own bar, and the stock was up as much as 7.6% after hours on a capex guide that's actually bigger than what spooked everyone with Alphabet. Both of us were right about two different companies in the same news cycle.
Which is really the whole story of the night, and we'll get to it properly in a minute. Dave had a call too, even though he's not with us today. Semiconductors, the SMHETF, closing positive would mean the 4-day rout found a bottom.
It didn't. SMH fell more than 3% for a fourth straight session Wednesday. Dave's not going to like hearing that from a distance.
He'll survive. Scoreboard update, Eleanor moves to 8-5, streak of +3. Marcus 6-9, but that snaps your skid. Streak resets to +1. Dave falls to 0-2, streak -2, streak -2. Sarah's still sitting at 0-1. No call in the mix yesterday.
I'll take snapping the streak. 6-9 still reads like a rough quarter, but I'll take the direction.
Fair. Let's get into what actually happened because the Dow's worst day since April undersells just how much landed on the tape at once yesterday.
It really was three shocks stacked on top of each other. The Dow dropped 1153, 2.19%, to 51,594, its worst single session since April of last year. The S&P fell 1.52% to 7316, the Nasdaq 1.74% to 2443.30. Small caps took it even harder. The Russell 2000 down 1.61% as long-end yields jumped and hit the more rate-sensitive names hardest.
And that headline number actually understates how violent the last hour was.
It really does. Coming out of the 2 o'clock decision, stocks caught a real relief bid. By 3 o'clock, the Dow was only down about 1%, and the S&P and Nasdaq had both flipped positive, up 2 and 0.5% respectively on the hold itself.
So the hold was greeted as good news at first.
Initially, yes. Then Chair Warsh's press conference happened, and whatever he said in that room, the tape did not like it. Between 3 o'clock and the closing bell, the Dow gave up something like 500 additional points, and the S&P and Nasdaq both round-tripped from green to solidly red. That's the real story of yesterday. It's not that the market fell all day, it's that it tried to rally on the decision and got sold hard once Warsh actually started talking.
Which tells you the market wasn't reacting to hold, it was reacting to tone, and once traders had an hour to sit with 3 hawkish dissents and whatever Warsh said about them, out loud, they decided they didn't like what they were hearing. A press conference that unwinds a relief rally into a worse close than before the decision even happened is about as clean the market doesn't trust this Fed's messaging signal as you'll see.
And the actual trigger was the Fed, not the market, just deciding to have a bad day.
The Fed held at 3.5 to 3.75%, which was expected. What wasn't expected was 3 policymakers, Cleveland's Beth Hammack, Minneapolis's Neil Kashkari, and Dallas's Lori Logan, all dissenting in favor of a hike instead. That's the first 3-way hawkish split since September of 2016, and Kashkari joining it caught almost everyone off guard. He hasn't been the hawk in the room.
Give me the mechanism. Why does a hold, with no change in the actual rate, hit stocks harder than a hike everyone saw coming?
Because the 10-year yield jumped 7 basis points to above 467, and the 30-year climbed 10 basis points to above 5.2, its highest since 2007. When a hold gets read as falling behind, not steady, it's the long end of the curve doing the repricing, not the policy rate. And long end yields are what actually price mortgages, corporate borrowing, and equity valuations. That's why yesterday hurt more than a straightforward hike would have.
Translate long end of the curve for anyone who just wants to know if their mortgage rate moved.
The Fed sets the overnight rate directly. Everything past a couple years out, the 10-year, the 30-year, is set by what bond traders think inflation and growth will look like for the next decade. And that can move even when the Fed does nothing at all. Yesterday, it moved a lot.
I'd add the quote that's sticking with me. BMO's head of U.S. rates said the market's now reading this as, quote, a committee with vocal hawks. That's a real shift in how the Fed's reaction function gets priced, not just a headline dissent count.
Kaskari specifically. Why does one name flipping matter more than the vote count itself?
Because he spent most of this cycle as one of the more balanced voices on the committee, not a reliable hawk. When someone who's been willing to look past noisy data suddenly votes for a hike, that's a signal the underlying inflation data itself has shifted his read, not that he's just following a faction. Committees move as blocks eventually. The third vote is usually the one that tips the next 12 months of guidance, not the first.
How worried are you on a scale of noted to rewrite the playbook?
Somewhere in the middle, honestly. Inflation's still running around 4.2% year over year, well above target, so 3 hawkish votes isn't crazy. It's arguably overdue. What I don't buy yet is that this changes the base case for September. Warsh still held the line at the podium. He just held it against more internal resistance than anyone priced in.
I'd frame it a notch more seriously than noted. Once a committee shows you it has a real hawkish block, every future data print gets read through that lens. A hot PCE number now has 3 votes ready to push for a hike. Instead of one lonely dissent, everyone could shrug off. The market's repricing the distribution of outcomes, not just yesterday's decision.
So walk me from the Fed straight into oil, because that's the other after yesterday, and it didn't wait for the podium.
It didn't. WTI spiked 6.4% to 84.31 a barrel. Brent up 6.6 to 89.61 after President Trump vowed the U.S. would hit back hard at Iran following an attempted strike on American forces. The ceasefire's on and off pattern finally broke a lull that had held for a few days.
And overnight, it actually happened.
It did. U.S. Central Command carried out what they're calling a, quote, powerful response against Iran overnight. Trump had telegraphed it hours earlier. Brent's up again this morning, 1.5% to 92.10. WTI up 0.9% to 85.23.
So the de-escalation trade from earlier in the week is fully unwound.
Fully. 2 days of oil grinding lower turned into 3 days of it ripping higher, and now there's an actual retaliatory strike on the tape instead of just a threat.
And the layer that matters for our audience, that's not just a geopolitics story, it's a Fed story. Warsh has spent weeks drawing a line between energy-driven price spikes and the underlying inflation fight, saying the Fed should look through the former. A crude spike this size, this fast, makes that distinction a much harder sell in public, especially with 3 colleagues already on record wanting to hike.
Does a resurgent oil price change what today's PCE print means when it lands at 830?
It changes how it gets read, even if the number itself doesn't move. A hot PCE print today lands on a committee that just showed you it has real hawkish teeth. A cool one gives Warsh more room to keep calling energy moves temporary. Either way, the stakes on one data release just went up because of what we learned about the committee's mood yesterday.
Let's move to the story that actually ate the whole evening. Microsoft and Meta, minutes apart, telling completely different versions of the same AI spending story.
Microsoft first because it's the cleaner win. Fiscal fourth quarter revenue of $90 billion, beating the $87.6 billion consensus. Adjusted earnings $4.74 a share against $4.24 expected. Azure grew 43% in constant currency, well past the roughly 40% the street wanted. and crossed $100 billion in annual revenue for the first time in the company's history.
And the number everyone was bracing for, fiscal 27 capex, came in at $255 to $260 billion, up from around $190 this year. A genuinely enormous step up, and the stock rallied anyway, up as much as 7.6% after hours.
Why does a bigger spending number read as good news there and terrible news on the other side of the earnings call an hour later?
Because Azure crossing $100 billion is proof to spending's converting into bookable revenue right now, not a promise about revenue someday. A bigger capex number on top of that reads as confidence, not risk.
Meta's the opposite lesson. Revenue of $60.8 billion did beat the $59.5 estimate, up 28% year-over-year, genuinely strong on the top line. But adjusted earnings of $618 missed the $713 consensus and fell 13% from a year ago as AI infrastructure and legal costs piled up. Management guided third-quarter revenue to $61 to $64 billion, with the midpoint under the street's $63.2 target, and raised the low end of full-year capex to $130 billion from $125. The stock fell about 4% on the initial print, then kept sliding to roughly 10% as the guidance call played out.
Same night, same theme, opposite verdicts. That's exactly the split you two argued about all week. So who actually won that argument?
I think I did, and I'll say why plainly instead of hiding behind nuance. Microsoft and Meta both have real, profitable engines funding the spend. Azure, the ad business, and the market just proved it treats that kind of capex completely differently from Alphabet's or chip makers. Microsoft's bigger number got rewarded. That's the distinction I was drawing all week, confirmed in real time.
I'll take my loss on Meta specifically without dressing it up. But I don't think this fully resolves in Marcus's favor. It actually sharpens my point. It's not cash-generative companies get a pass on capex. It's that the market is now pricing every hyperscaler's AI spend against its own visible payoff, quarter by quarter, and punishing anyone whose margin story goes the wrong direction while the bill keeps growing. Meta's margin compressed hard funding this. That's the part that got punished, and it can happen to Microsoft too, the day Azure growth ever disappoints.
That I'll actually agree with. It's not a free pass forever. It's a report card, and Microsoft got an A last night.
Let's turn to the other side of the chip story, because while big tech was splitting on capex, the actual chip complex kept cracking, and this is where I think you two still disagree. So let's not paper over it.
We do, and I don't think we're going to land in the same place today. The semiconductor ETF, SMH, fell more than 3% for a fourth straight session. Micron down 5.7%, AMD down 5.8%, even as Nvidia and Intel also slipped. Overseas, it's worse. SK Hynix tumbled 14.7%, Samsung fell more than 13%, and that's despite Hynix posting record quarterly profit. A record quarter getting sold off is the tell. A market this unforgiving on merely spectacular is a market that's genuinely nervous about the whole complex, not rotating out of one crowded name.
Here's where I push back, and I mean it, not just to keep the segment lively. Look at the internals from Tuesday's close. Before any of this started, 161 stocks hit new 52-week highs against just 53 new lows. A 3-to-1 ratio, actually better than Monday's already healthy 1.7 to 1. That is not what a market falling apart looks like under the hood.
Give me a level, not a vibe, on both sides of that.
Fine. The semiconductor sector's own 14-day RSI dropped below 50 for the first time since late March, after holding overbought for close to 2 months. That's the momentum trade genuinely resetting, and fear and greed sits at 38.6 in fear territory. If SMH extends this slide into a fifth or sixth red day, this stops being a healthy reset and starts being the crack Dave's been tracking spreading from Asia into the US.
And my level is the new high, new low ratio itself. As long as it holds above roughly 2 to 1, the broadening thesis stays intact. Capital's just rotating out of the most overbought corner of the market into the other 490 names, which is exactly why breadth keeps expanding even while the cap-weighted indices wobble. If that ratio reverses back toward 1 to 1, I'll concede Eleanor is red.
So what would actually change your mind, Marcus? Not what supports your case. What would break it?
2 straight days of new lows outpacing new highs. That's the one thing I can't explain away as rotation.
And for me, it's SMH itself. One green close breaks the route is spreading case for the week. I don't think we did it today, given the overnight oil news adding another reason to de-risk. But I'd take the L happily if I'm wrong.
I'm going to leave that one right there, split, because forcing an agreement would be dishonest. Watch the new high, new low ratio, and SMH's next close, and you'll know by tomorrow which one of them had the better read. Quick round of other earnings before we get to today, because there's real signal buried in the also trans. Starbucks and Carvana, opposite directions.
Starbucks crushed it. Adjusted to earnings of 85 cents against 66 expected, revenue $9.32 billion versus $9.16, global comparable sales up 7.9%. They raised full-year comp guidance to slightly greater than 6% and lifted the earnings outlook to $255 to $265. Shares jumped 5% to a 52-week high.
That's a genuinely good read on the U.S. consumer, which matters given how soft confidence data has been running. Carvana's the counterweight. Net income rose to $513 million, vehicle sales up 38%, but full-year EBITDA guidance of $2.7 to $3 billion trailed what the street wanted, and gross profit per unit actually declined. Shares tumbled as much as 14%.
One company selling more coffee at better margins, one selling more cars at worse ones.
Exactly, Vittel. Growing the top line isn't the story anymore for anyone. It's whether the growth is actually getting cheaper or more expensive to deliver.
And then there's CoStar, which is its own strange animal entirely.
CoStar's the one I'd flag as a lesson in patience running out. Shares are now roughly 70% below their 52-week high of 97.43, trading in the mid to high 20s, after falling as much as 12% on Tuesday's report and continuing to slide. The headline numbers weren't even bad. They beat on earnings, grew revenue 18%. What spooked everyone was a soft third-quarter guide sitting on top of a year-long argument about whether their multi-billion-dollar Homes.com bet against Zillow will ever pay for itself.
Management's response is actually the interesting part. A new $1.5 billion buyback and a plan to cut Homes.com spending by more than $300 million next year, targeting break-even by 2029. That's a management team finally treating the moonshot as a cost to contain, rather than something to fund without limit. 2 activist campaigns have already hit the stock this year. This reads like management getting the message.
All right, before we get to today, one non-market minute. Eleanor, you're supposedly still on the structured caffeine program.
Week 3. Going well, thank you for asking.
Structured caffeine intake is just a fancy phrase for I drink coffee on a schedule now.
It's a fancy phrase for I stopped crashing at 2 in the afternoon, which is more than I can say for whatever you're doing.
I love that we've turned a Fed day into a referendum on Eleanor's coffee habits. Back to markets. Let's get to today, because 8:30 this morning is loaded.
Genuinely loaded. Second quarter GDP, first estimate, is expected at plus 2.3% annualized versus plus 2.1 prior. Initial jobless claims, prior 187,000. Continuing claims, prior 1.796 million. June personal income expected up 0.3% against 0.7 prior, and personal spending expected up 0.4 against 0.7 prior.
And the big one.
The big one is June's PCE price index, the Fed's preferred inflation gauge, headline expected down 0.1% month over month, but up 3.6 year over year. Core expected up 0.1 month over month. Given what we just spent 20 minutes discussing about a newly hawkish committee, this print carries more weight than it would have a week ago.
And tonight, Amazon reports after the close, closing out the week's hyperscaler earnings run and giving us a fourth data point on the exact same capex question Microsoft and Meta just answered 2 different ways. Analysts are looking for $182 a share on revenue near $197 billion. With AWS expected around $40 billion, up roughly 31%. Some desks, Bank of America among them, have pushed that estimate to 33. There's also chatter that Amazon could raise its own 2026 capex guide toward $210 billion, up from the $200 already on the books.
So after last night, which side of that does Amazon look more like walking in? Microsoft or Meta?
On paper, more like Microsoft. AWS is a genuinely profitable, growing engine, the same setup that got Microsoft rewarded. But retail margins are thinner than Azure's, And if the capex number surprises meaningfully to the upside without ASON growth accelerating to match, I could see this trade the same way Meta did.
I'd bet the other way, and I'll make it my call for the day rather than just an opinion. If ASM growth clears 31% and the stock holds up or rallies despite a bigger capex guide, that's a third hyperscaler in 1 week, proving the market rewards cash-generative capex. Not a coincidence anymore, a pattern. That's mine, checkable by tomorrow's close.
Eleanor, give me yours.
Mine's on the bond market, not stocks. If the 10-year yield closes today above 4.7%, that's confirmation this is a sustained hawkish repricing after yesterday's descents, not a one-day Fed decision spike. Below that, and I think some of yesterday's move fades as the shock wears off.
Before we close out, give me the one-sentence version for anyone who's only got 30 seconds before their own 8:30 starts. Hot PCE? Cool PCE. What actually changes for them?
A hot core print, anything meaningfully above that 0.1% monthly pace, and you should expect yesterday's sell-off to look like the opening act, not the whole show. Rate cut hopes get pushed out further, and richly valued growth names take the hit first. A cool print gives the market permission to treat yesterday as a one-day scare and move on.
And I'd just add, watch jobless claims alongside it, not instead of it. A weak labor print on the same morning as a hot inflation print is the one combination that actually makes the Fed's job genuinely hard, not just uncomfortable. Good growth, cool inflation is the best case by far, and it's not the least likely outcome either.
2 checkable calls, both resolving by tomorrow morning. So here's today in one breath. A GDP print and the Fed's favorite inflation gauge landing at 8:30 on a committee that just showed real hawkish teeth. Oil sitting higher after an actual overnight U.S. strike on Iran. Amazon closing out the week's AI capex verdict tonight. And a chip complex that Eleanor and Marcus still can't agree is healing or cracking. Watch the 10-year. Watch AWS growth. Watch whether SMH can finally close green. If the show's useful to you, follow Nova Ventures Daily wherever you get your podcasts, and find our daily charts and reels on Instagram at NovaVentures_US. That's your Thursday morning brief. Have a great day, and we'll see you next time.